So Mike, let's talk about benchmarking. Can custom target date strategies be benchmarked?
Yes, they can be benchmarked, but the benchmarks should be custom, like the strategy. I don't believe there's one size fits all in the custom benchmark arena, or in the benchmark arena as a whole. The whole idea of benchmarking to averages, I think, is inappropriate, particularly in the custom world, because the whole idea behind the custom is that it's custom. It's yours. It tailors to your characteristics and the participants in your plan's characteristics, and should be measured against something appropriate to that.
Let's talk about what is appropriate. If you were to help a company benchmark custom target strategies, where would they begin? What should they absolutely do?
Well, I think the first place to begin is, ultimately the power behind any target date fund is the investment options. Who are the asset managers hired to implement each of those asset classes? And it looks no different than benchmarking a pension fund. Who have you hired? What have you hired them for? What is their benchmark for the particular slice of the target date fund that they're supposed to implement? And how well have they done against that? Once you've accomplished that component, then there's the whole idea of, is the glide path correct? And that's the harder thing to benchmark, because there's no good way to say this is the right benchmark and that's the wrong benchmark, or you should have more equity or less equity, or more bonds or less bonds, or more tips or less tips, or more international or less international. I think you have to have as a custom target date follower, you really have to have the belief that your methodology for establishing the risk level for any given place along the target date line, glide path, is appropriate. So it's really more of a belief on the glide path that you've got it appropriate, and not so much one of hitting the right spot that someone else has designated.
Do you see any benchmarking approaches developing in the marketplace today that are particularly helpful?
Yes, my favorite way of benchmarking a target date fund is to actually examine the participant as an individual, their allocation to the target date fund, their savings rate in terms of how much they're saving and putting away today, and actually doing a calculation to say, with a given probability, how likely are they to be able to replace some percentage of their income at retirement. So it's really truly has the target date fund lifted the boat of each individual participant in terms of retirement readiness. That's my favorite benchmark, because that's really what a target date fund, what any retirement fund is supposed to be able to do, is help the investor get to retirement with enough money to fund their retirement income desire. And that's, there are a lot of technologies out there now that are beginning to accomplish that.
And that, if you're looking at whether a target date strategy may help the participant meet their goals, that's prospective. It's not looking in the rearview mirror.
No.
And how do you get that right? Because there are so many assumptions that a plan sponsor would need to make, right, or their consultant.
There are a number of assumptions that you have to make within doing this sort of prospective approach to benchmarking. The biggest ones, frankly, are the capital market assumptions. What do you think are the distributions of the various asset classes in your target date portfolios? But again, you're making those assumptions, the asset managers are making those assumptions every day. They're making them to run the portfolios. The plan sponsor's making them when they're buying the investment products and managing them through time. So it's not like those things are uncommon. You don't have to go out of your way to find them. Once you've done that, though, the calculations are, while they may be daunting in terms of the numbers of calculations that need to be done, how many simulations do you run, what sort of distribution do you use to draw from, what sort of tax rates do you assume, what sort of inflation rate do you assume. But the other calculations are relatively straightforward. How much are they earning today? What sort of replacement of that income would you like to assume? What's their current asset allocation or the target date fund's allocation? If it's a custom fund, you know the glide path, so you can bake that into your prospective illustrations. So, while they are daunting in terms of the numbers of calculations that need to be done, I don't believe that people are doing anything more within those prospective calculations than they're doing today in managing their portfolios.
So Phil, in helping plan sponsors benchmark custom strategies, what would you suggest to them?
I think the first thing is really to define the glide path that you're looking at. And as we look at custom structures, the important thing is understanding the structure. If you understand the structure, you then are going to have an understanding of what the resulting performance is. So you define the glide path, which essentially gives you your structure, how aggressive you are, kind of what is the allocation as participants approach retirement, kind of what's the allocation as people move past retirement. I think that's a significant point of differentiation among various products. The second thing then is, again, defining the investment roles utilized to implement the glide path, and defining the managers that you utilize to implement those roles. The evaluation part of it really comes down to a couple of things. What's the level of risk that your allocation strategy provides over time, and what's your comfort level with that level of risk? The second point is you're interested in the performance of your underlying managers, as you would be in any other investment structure. And then the third part is a little bit more of a challenge, because it's evaluating what's the probability that this structure is going to result in a meaningful benefit at retirement for a participant. And what's the ability that you're going to have a sufficient block of assets to provide an income stream while in retirement. So those are the three things I would focus on.
If you're going to help look at the retirement income adequacy coming out of a glide path, how do you go about doing that?
Well, that's a little bit of a challenge. Essentially what we do is run various stochastic simulations as to what our expectation is with respect to investment performance over time. This is also based on capital outlooks that we have. And essentially what we're looking at is the stochastic modeling is the expected return, basically the 50th percentile, as to what is there a 50% or better probability that this is going to generate a meaningful benefit. The other thing that we look to it as well, and I think this is important, everybody assumes everything goes right. And when you look at modeling or evaluations of modeling, it's also important to get an understanding of, yes, it's nice to know what happens if everything goes right, but also you need to have an understanding of what the downside risk is, if everything does not go right. So as we look at things, we kind of establish a range. We have the expected outcome, but we pay a lot of attention to, okay, what's the downside risk associated with this?
So Lori, what are some of the best ways that people can go about benchmarking, particularly custom target date strategies?
Well, we did a survey recently and found that the most common way benchmarking is done is just to use the passive mix of the investment manager's index. So to use the index provided by the investment manager. And that certainly can help you understand the active manager value added of the custom target date fund or whatever target date fund you're evaluating. But unfortunately, that really only gets to a part of the overall performance, because the thing that really is going to influence performance quite a bit, obviously, is the glide path. And there's a lot of indices out there now that allow you to benchmark the glide path as well. So there are objective benchmarks that allow you to understand, whether the glide path you have is in line with others, is more aggressive, and in what ways more aggressive and conservative. I think that's important because as a plan sponsor, you want to feel that you understand the, where the risk is within your glide path, and where, and the extent to which there's the downside risk, especially for those close to retirement.
And Lori, if you're working with one of your clients and they're interested in benchmarking, what would you suggest to them?
I would suggest that they break out the benchmarking into component parts, so understand what's driving performance both from the perspective of the manager value added, active management, both from the point of view of alpha, but also from rebalancing and straying from the target. But also understanding the extent to which the glide path is driving performance, and are they comfortable as a plan sponsor with the way that the glide path is driving performance. There should be no surprises, and a lot of times how these custom target date funds, in fact any type of target date funds are chosen is based and developed is based on projecting out what the likely outcomes will be in the long term, and further what the likely outcomes might be in downside scenarios like we saw in 2008. So the glide path results, the actual glide path results, should fit into that context. And if they're surprising relative to what you thought you were picking, then that should be a red flag.
And with custom strategies, is there a particular type of benchmarking that you would suggest? And is there a particular advantage to custom strategies when it comes to benchmarking?
I think a key advantage to having a custom target date fund when it comes to benchmarking is the fact that there's steps you can take to change the glide path if in fact you find out through benchmarking that you're uncomfortable with aspects of the glide path. The analysis of the glide path when it is a target date mutual fund can only lead you to one outcome if you're unhappy with the glide path, which is to get another target date mutual fund in your plan. But when you have a custom target date fund, you can actually take action and work to address any issues you find in your glide path analysis.
Now, does that hold for the underlying managers as well?
Yeah, certainly within the open architecture type of an environment you have with a custom target date fund, if you find that through the active management of certain of your underlying investment managers that they're not achieving the goals that they set out to, you've got the flexibility to replace them. And that's another way that a custom target date fund differs pretty substantially from a target date mutual fund, where again your only recourse if you're unhappy with the underlying manager's performance is to fire the whole target date series and replace it.
If you were to work with a company on benchmarking their strategies, what do you believe is the most important thing for them to do?
Well, the most important thing for them to do is to think of the fund family as a whole and not just look at trying to compare each individual sleeve of the target date fund versus other sleeves, because that doesn't really give you an answer. Let's say your benchmarking approach tells you that the 2050 fund, your 2050 fund is doing well versus others, and your 2010 fund isn't doing well. Well, that doesn't really help you much, because you're not going to pick the 2050 fund from one fund family and the 2010 fund from another fund family. We'd recommend that plan sponsors take more of a cash-weighted approach to evaluating how well their target date funds are doing in building retirement income wealth. So it's looking at historical performance of the target date fund family as a whole and seeing how well that fund family has done in building retirement income adequacy.
Josh, in working with clients on custom target strategies, how would you go about benchmarking those?
Well, custom strategy can be benchmarked the exact same way as any other strategy. You're still looking at, if it's looking at historical performance measures, you're still going to have that same performance track record. If you're looking at forward-looking measures, again, you can use the same kind of methodologies you would do for a mutual fund. So I don't really see much difference between a custom strategy and a mutual fund in evaluating target date fund performance.
Are there some advantages with custom strategies when it comes to benchmarking?
Well, when you do your evaluation process, if you don't like how the results of your custom strategies are coming out versus a mutual fund, there's something you can do about it. When you have a custom strategy, you can change asset classes, you can adjust the glide path, you can put different managers in. When you have a mutual fund that you're buying off the shelf, you don't have control of the underlying strategy and asset classes.
In terms of benchmarking and sharing benchmarking information with participants, what approach might make sense?
At Morningstar, we recommend a couple of different benchmarking options. Certainly an industry index, whether it's a single index, or we work with a consultant and a plan sponsor to create a blended benchmark of multiple underlying investments by asset class, category comparisons. So using the distinct category or group of peers for that particular time period of the target date, and then showing the actual versus the target allocation, and again, that's just the asset allocation weighting.